Hello, Advanced Financial Accounting. We're going to start today with new lectures. Remember, we have part one, we finished part one, and we finished part two, and we have exam. We still have part three for cost method and equity method. Our second exam will be mainly cost method and equity method, including how to compute goodwill, how to prepare the worksheet, all of this from part one and part two, but mainly for cost and equity. Today we have a new lecture. This about part four. What about part four? If you look at it, look at here, part four for intercompany merchandise transfer. When I say intercompany merchandise transfers, what's the basic issues here? What do we mean by intercompany? Some relation between two companies, parent company and its subsidiary. Start with theory first. When I come to theory, we need to talk about intercompany transaction. What is it? Merchandise inventory transferred, talk about inventory, merchandise inventory. And when you have inventory, we have a sales revenues. What are you going to do with revenue recognition? How are you going to recognize the sales revenues between parent and sub? And ending inventory. What are you going to do with ending inventory at the end of the year? Okay. When you come to practice, we're going to discuss equity method and the consolidation procedures from part one and part two. We have the same steps how to prepare consolidation worksheet. Under equity method for inventory, we're going to talk about upstream merchandise transfer. What do you mean by upstream? We need to discuss this. When I say upstream, what is it? And downstream merchandise transfers. What's the difference between upstream and downstream? That's basic issues for this one. Start with the first issue, intercompany transactions. Intercompany transactions are financial transactions between two companies. Parent company, assume A company as a parent, and B company as a sub. We have two companies. What kind of intercompany transaction do we have? First, loan from A company to B company. That's kind of transaction. They need a loan, and instead of going to the bank, they take a loan from A, the loan from A to B. Or opposite, loan from B company to A company. We have also A company sells the merchandise inventory to B, or B company sells the merchandise inventory to A. This kind of intercompany transaction between parent and sub. After this chapter or this part mainly focus on merchandise inventory. That means intercompany merchandise inventory. I'm going to start with upstream sale. When I say upstream sale, what do you mean by upstream sale or upstream transfer? Means B company, subsidiary, sells merchandise inventory to A company. We call it upstream. That's upstream, means who's the seller and who's the buyer. This one here, B company, seller, merchandise to A as a buyer. Opposite, what about downstream sale or transfer? Means A company, parent, sells, is a seller now, merchandise inventory to B company, subsidiary. Now we have upstream and downstream. That's the definition. What do you mean by upstream? What do you mean by downstream? You have to know this from the beginning. What's upstream? What's downstream? Who is the buyer and who is the seller? That's very important. Number three, when I have sales revenues from upstream or downstreams does not recognized until the merchandise inventory is sold to unaffiliated party. What do you mean by unaffiliated party? Means outside consolidation. Remember again, company A and B they're affiliated because A is a parent and B is a sub. That means other company after this, not including A and B, this one here will be outside consolidation, we call it unaffiliated. I'm going to give you example to explain this. Examples. Company A owns 80% of outstanding common stock of B company. Okay, that's first information. Second information, assume A company sold, he's a seller now. A company sold merchandise inventory to subsidiary, B company. A and B are affiliated. That's parent owns 80%. That's this one here, we call this affiliated A and B. The sales revenues does not recognize until the merchandise is sold to company C. Company C is an affiliated. That's very important. What about the gross margin? Gross margin means sales revenues minus cost of goods sold. This one must be deferred. Deferred means unrealized until the merchandise is sold to unaffiliated parties. The same like the other one. Next, if the cost of merchandise transferred is unknown, they didn't give it to you, it can be estimated by markup percentage of cost or by gross margin rate on sale. What do you mean by this? What do you mean by markup percentage? What do you mean by gross margin rate? Let me explain this to you, okay? Example, assume company A, parent, sold the merchandise inventory of its subsidiary. B company selling price, transfer price or selling price is 10,000, but the cost of the merchandise sold, it is unknown. They didn't tell you how much is the cost, but they give you the price, selling price, but they didn't give you this, okay? And I'm going to take case one. Case one first. If gross margin or profit of parent is 25% of the cost, then the cost of merchandise sold is 8,000. How I get 8,000? That's shortcut. I take 10,000 selling price divided by 1.25. 1.25, it give you, that means this cost is 8,000. Okay. What's the equation? Look at the equation. You can do it this way, shortcut, or you can do it with the equation. Shortcut, you take 10,000 divided by 1.25, it gives you 8,000. What are we going to use the equation? Gross margin or profit equal to transfer price minus transfer price divided by 1 plus markup percentage on cost. That means this one again, 10,000 minus 10,000 divided by 1.25, it gives you 2,000. Where is 2,000 come from? 10,000 minus 8,000. That means selling price is 10 and the cost is 8. That means the difference between selling price and the cost of goods sold, 2,000. The same number, 8,000. That means the same number, 8,000 cost of goods sold. Okay. Let's continue. Case 2. Case 2, we need to come to conclusion, the same number, cost of goods sold, 8,000. If gross margin or profit of parent is 20% of selling price or transfer price, then the gross margin is 10,000 multiplied by 20%, it gave you 2,000. That's a gross profit or gross margin. Now you have two numbers. You have 10,000 and you have 2,000. If you take 10,000 selling price minus 2,000, that's a profit. It gives you 8,000 cost of goods sold, the same number, 8,000. The equation for this case number 2, gross margin equal to transfer price multiplied by gross margin rate on transfer price. That means, look at here. That means here, 10,000 multiplied by 20%, it gives you 2,000. The cost of merchandise transfer, then 10,000 minus 2 give you 8,000. In both cases, case 1 or case 2, the cost of merchandise sold or transferred is 8,000. That's you have to know, it depends which one you're going to use, which rate, it depends on the question. I will give it to you. Okay? Let's continue. What about downstream sale? The gross margin profit from merchandise sold from parent company to sub appears in parent company because parent is a seller. In upstream sale, the sale from sub to parent, the gross profit or gross margin of selling the merchandise appears in subsidiary because sub is the seller. You have to know who's the buyer and who's the seller. That's very, very important with journal entries, with any other question. You have to know downstream sale and the upstream sale, how to distinguish between upstream and downstream. Next one, talk about the parent investment account must be adjusted. The parent investment account must be adjusted for downstream sale or upstream sale transfer. What do we adjust it? How are we going to do it? I have to give you example to explain this. Next, consolidation procedures. For equity method, for this one you're going to use a consolidation procedure the same as previous chapters. From chapter 2 and chapter 3, as we have 5 steps. You have to know 5 steps, how you do it, from how to prepare consolidated financial statement and worksheet. Okay. Additional consolidation worksheet adjustment related to merchandise inventory transfer, and you have to be careful, is this upstream again or downstream? Now let's go for some examples. I have 6 examples for you. I'm going to do one by one. First one, upstream sale year 1. Example 2, upstream sale year 2. Why I give you 2 years? Because year 1 ending inventory in year 1 will be beginning inventory in year 2. That's why we have 2 years. That means example 1 and 2. Example 1, upstream sale year 1. Example 2, upstream sale year 2. When I come to example 3, downstream sale year 1 and downstream sale year 2 is the same. Okay, 2 years for each one. Example 5, I'm going to give you a consolidation worksheet. I'm going to use downstream sale of inventory. I'm going to show you how we do this again, repeat again. The last example, example 6, consolidation worksheet upstream transfer inventory. That means we have example 5 and 6. That's only for consolidation worksheet. Let's continue. I go to example 1, upstream inventory intercompany merchandise transfer year 1, first year. During the year of 2001, B company sub sold the merchandise inventory to its parent A company for how much selling price? You need to know, 20,000 on credit. How much is the cost of merchandise sold? 16,000. We have two numbers now, 20,000 and 16,000. The difference between 20 and 16, it gives you 4,000. That's a gross profit. At the end of the year, look at this, that's the beginning of the year. At the end of the year, December 31st, the amount of 1/5, which is 25%, was remained unsold at the end of the year and was included in the parent's ending inventory. During the year of 2001, the sub-company reported net income of 2,000 and the paid dividend of 800. From this information, I'm going to ask you again, assume parent company owns 90% of sub and the annual amortization of valuation differential is 150. It's a given. This number, it's a given. He told you this one. Okay, let's continue. What's required here? Required, we need to prepare journal entries in subsidiary company and the parent company. Use perpetual inventory system. You have to know what do you mean by perpetual inventory system. Remember in accounting, accounting 1 and accounting 2, we have two systems for inventory. Periodic inventory system and perpetual inventory system. What's the difference? Periodic inventory system, they do cost of goods sold and the ending inventory at the end of the year. At the end of the year, they need to determine how much cost of goods sold, how much ending inventory. Under perpetual inventory system, continuous, every minute, every second, by computer, they're using the computer, they can find out how much the cost of goods sold, how much ending inventory. That's number one. You need to know what is the difference between periodic inventory system and perpetual inventory system. Journal entries will be different. How? Let me explain to you one by one. I give you here, first, prepare journal entries in sub, company, and the parent. Use perpetual inventory system. Number two, prepare consolidation worksheet adjusting entries related to inventory. Yes. Number three, compute minority interest and sub net income. I'm going to start one by one. The model answer for this example one. Start with journal entries in sub B company accounting books to record the sale merchandise. Remember, debit AR, that's sale on credit, 20,000, credit sales revenues. Also, they're going to make another company, another entry, company B. They're going to make another entry to record cost of goods sold. That means two entries. Record the sale of merchandise and the record cost of goods sold. Okay. Second entry, I go to debit, cost of goods sold 16,000, inventory 16,000. Look at the difference between sales revenues 20,000, cost of goods sold 16. The difference is 4,000. Look at the journal entry. Second journal entry, very important because they show you how much cost of goods sold. We need to put this in accounting books. Cost of goods sold 16,000 and inventory 60,000. That means for company B, he's going to make two entries. Okay. Let's continue. Let's go journal entry in A accounting books. A, he's a buyer. He's going to make one entry. What is it? Debit inventory 20,000 and the credit AB 20,000. And he's going to make another one. Record the share of net income from B, debit investment in B 930, credit income from B. I like to stop here for a second. See, where's this number come from? What's 930 come from? How I get this number from? We need more details. How to compute income from sub or from B. 930. Let me give you more information how to calculate this. Note 1. compute income from B. Upstream sale, year 1. Remember, upstream sale. And this first year, what you're going to do, look at the equation here. B net income, it's a given, 2,000, plus deferred gross margin or gross profit of upstream beginning of the year, that's 0. Because 2001, that's first year. We didn't have anything before, nothing before 2001. That's first year, usually I make it 0. What about deferred gross margin at the end of the year? I can get it. How I get this one? Sales revenues, 20,000, minus cost of goods sold, 16,000, give you 4,000, multiplied by 20% or 1/5. It gives you 800. Okay? You come to the end, adjusted sub net income, 1,200, which is 1,200. It was 2,000. We adjusted to make it 1,200. This 1,200, what you're going to do with this one, you go multiply it by ownership percentage. Company A owns 90% of B. That means this one here multiplied by 90%. Give you 1,080. Don't forget, usually we say minus annual amortization of valuation differential or goodwill. It's given already, 150. You take this one, it gives you share of B net income, 900. If you know this number, you have to put it in the entry before that's share of B net income. You need to explain before you write the entry, you need to calculate this one here, how to compute income from B. Upstream sale year 1. Note number 2, using the perpetual inventory system, company B, the seller, made 2 entries. Remember, as a seller, he made 2 entries. The first one for sales revenues and the other one for cost of goods sold, because he's a seller. He knows how much cost of goods sold. But company A, he made only 1 entry. Note number 3, look at this note, it's very important to explain to you. Note number 3, both companies, they use inventory account. Inventory, debit or credit, you can look at again. Number 4, deferred gross margin at beginning of the year 1 is 0, because year 1, nothing before year 1. That's always 0. Number 5, deferred the gross margin at the end of the year 1, 800. It's this one 800 goes to next year as a beginning for year 2. Okay. Also, I ask you, prepare consolidation worksheet adjusting entries. This adjusting entries, are you going to use it when I give you the worksheet, when we prepare the worksheet? But at this moment, I will give it to you to know this information related to inventory. This adjusting entries related to inventory. This one, defer upstream gross margin at the end of the year, debit cost of goods sold, 800, and get inventory. Second one, eliminate upstream transfer price from sales revenues and the cost of goods sold, debit sales revenues and cost of goods sold. Make it debit and make cost of goods sold. That's the opposite. Make sales the debit, make cost of goods sold the credit. Okay. Let's continue. After you come to this, you need to compute minority interest. Question number 3, minority interest and sub net income. To get minority interest, you remember company owns 90%, that means minority 10%. That means adjusted sub net income, which is 1,200, multiply 10%, it gives you 120. That's a minority interest in sub net income. That's example 2 would be year 2, upstream again, but year 2, okay, we're still upstream, okay, year 2, upstream intercompany merchandise transfer, year 2. Look at the information given. This is during the year 2, 2002, B company again sold merchandise inventory to parent A company. How much this year? 40,000 on credit. How much cost of goods sold? 32,000. You have two numbers now, 40 and 32. At the end of 2002, second year, 1/4 of merchandise transfer, which 25% of merchandise transfer remained unsold and was included in parent ending inventory. Okay. During 2002, you have to read this example. When you go home, read it and try to do it many times to understand how you, especially year 1, year 2, and next one for upstream and downstream. During 2002, SAB reported net income of 6,000 and paid dividend of 2,400. He asks you again, assume A company owns 90% of B and the annual amortization, the same number, 150. Let's have this example too for year 2. Question number 1 is the same. Journal entries in sub and the parent use perpetual. Question number 2, you're going to prepare consolidation worksheet adjusting entries. Okay, I'm going to show you this time the same. And how to compute minority interest. You have to know these 3 questions for each example. What is the model answer? Usually I give you a model answer to know how to answer this. Sometimes I give you only question 1, sometimes only question 3, but you need to know how to understand the whole question 1 and 2 and 3. I'm going to do it one by one with you. Okay, and please check with Hiba and Marina will help you, give you more details, and you can keep this study all of this. Start with journal entry again in B, because B he's the seller. Remember, C is the seller. He's going to record the sale of merchandise. He's going to debit AR again and the credit sales revenues. That's year 2. And the seller going to make another entry, cost of goods sold, debit, cost of goods sold, credit inventory, 32,000. Okay. After this, journal entries in parent. Remember, parent, because he purchased this inventory under the perpetual inventory system, he go to debit inventory. Inventory 40,000 credit AB. Also, the parent, they're going to make another entry, record share of net income from B. That means this one here, debit investment in B, credit income from B. 4,170. Again, you need to know how to calculate this number. Before you write anything, you need to know how to calculate this number, 4,170. Note, to compute income from B, to compute this one here, you need to know sub net income, 6,000, plus defer profit beginning of year 2002, that's 800 from last year. Remember, from last year, ending last year, beginning next year. That's 800 plus minus deferred profit ending, which is 2,000. Look at this one here. Where is 2,000 come from? 40,000 minus 32 multiplied 1/4. You come to the end, adjust the subnet income, 4,800, multiply it 90%, and the annual amortization is give you 4,170. Excuse me. Let's continue. Consolidation worksheet for 2002, second year. We're going to recognize 800 from last year. We're going to recognize upstream gross profit from 2001, which is 800, remember? Debit return the earning beginning, credit cost of goods sold, and defer upstream gross profit at the end of 2002, cost of goods sold, inventory, and we have 2 entries now. This one here, recognize upstream gross profit, recognize 800, and differ ending. That's recognize beginning, differ ending. Also, eliminate upstream sales and cost of goods sold. Sales revenues 40,000 and the credit cost of goods sold. Always like this, debit sales revenues, cost of goods sold. How to compute minority? The same. You take adjusted sub net income, which is 4,800, multiplied by 10%. That's what we have for this one. Let's continue. Example 3, similar to example 1. Again, the same number, the same information, except this one downstream. That's why I give you the same numbers, sales, revenues, cost of goods sold, all of this, except this one downstream, enter company merchandise transfer, year 1. That means example 3 and example 4 for downstream. Let's start example 3. During the year 2001, again, A company sold, he's a seller now, A is a seller, merchandise to B, how much? 20,000, credit, cost of goods sold 16,000, the same information, 1/5 remained unsold, same, and B company net income was 2,000, same information from example 1, and the assumed parent owns 90%, same information, and the annual amortization for this one here was 100. The same information for example 1, except this one downstream. We need required question number 1, journal entries, the same for A and B, perpetual inventory system, and prepare worksheet adjusting entries, you're going to see some differences, and compute minority, you're going to see some differences here. Okay, let's see how to do example 3 for downstream. Again, the model answer, usually I give you the model answer to know what's the right answer. You didn't have to memorize it, but you need to understand how to do it. Where does this number come from? And start one by one. Journal entries first. In B, accounting books. To record inventory, company B, he buys this inventory. He's going to debit inventory and the credit AB. That's it for company B. Journal entries in A as a parent, he's a seller. He's going to make record merchandise inventory sold, seller, debit AR, credit sales revenues, and second one, cost of goods sold, debit cost of goods sold, credit inventory. After this, record net income from sub. How much is it? Investment in B 850, income from B 850. Again, we need to explain before you write this number, you need to do some calculation how to get this one for downstream. Let me show you how to get this number 850. What's the difference between upstream and downstream? Note number 1 again, compute share of net income from B, downstream sale, year 1, don't forget, year 1, sub net income 2,000. Look at here in this example, we multiply it right away by percentage, 90%, because this one downstream, no adjustment here for company B. Just multiply downstream, multiply sub net income by 90%, it gives you 1,800, 1,800, which is parent share of sub net income. You see the difference between upstream and downstream now. Look at the difference between example 1 and example 3, okay? And you're going to say differ profit beginning, that first year always 0. Differ profit ending 800, the same number, 20,000 minus 16, it gave you multiplied by 1/5, it gave you 800. The same number we gave it, and you come to annual amortization. That's we have to get to 850. What I'm saying here, you have to know how to calculate this under upstream or downstream. Okay? Continue. No need to adjust the subnet income. Why? Because parent company is a seller. Okay, that's downstream. Parent is a seller. Second one, prepare consolidate worksheet adjusting entry for downstream sale again year one. Okay, differ downstream gross margin goes to 800, cost of goods sold debit, and inventory ending credit. You know 800 come from, that's 20,000 minus 16,000 multiplied by 1/5. Also, what do you need to do? You need to eliminate downstream sale. Sales revenues, debit, and cost of goods sold credit. I go back again to example 1 and example 3. See what's the difference between example 1 and example 3. When you come to minority interest in subnet income, you take the same number, 2,000, no adjustment, 2,000 subnet income multiplied by 10%, it gives you 200. Okay? Example 4, that's the last example, example 4. This example similar to example 2. Remember example 2, year 2? Same numbers, except this one here, except this one downstream. Let me read it again. Downstream intercompany merchandise transfer, year 2. During 2002, the parent company sold the merchandise. A is a seller now. Remember, A is a seller. That's downstream. 2 sub, same number, 40,000 credit. The cost of goods sold was 32. The same information in example 2. The end of the year, 1/4 remained unsold, and they gave you net income 6,000, dividend 2,400. As you, the same information was go for requirement here. Required one, journal entries in sub and parent, worksheet adjusting entries, and minority. Start one by one. What's the model answer for this one? First, journal entry in B account box to record the inventory purchased from A, that's company B. They're going to debit inventory and they credit AB. Okay, and because he's this one here, he's a buyer. Journal entries in A accounting box. Remember, A is a seller. Record the sales is a seller. Usually, under the virtual inventory system, you have 2 entries. The first entry, record the sales, AR, credit sales revenues, account receivable sales revenues. Second one, debit, cost of goods sold, credit inventory 32. Another entry, record the share of net income. Again, share of net income. How I do this? Journal entry is the same. Debit, investment in B, credit income from B. Investment in B. How before you write this number, you need to do some calculation. How I get this number? Let me show you in details how to compute share of net income from B. You start with B net income, 6,000. Multiply it, that's downstream, multiply it right away by percentage, 90%. It gives you 5,400. Plus deferred profit beginning from last year, 800. And minus deferred profit ending, 2,000. It gives you 4,200. Minus the annual amortization of valuation difference 150, it gives you 4,050. It's the same number. You put it, if you come to this number 4,050, you put it up there in journal entry. That's you need to practice this one by one. Okay. The adjusting entries for the worksheet. First, you need to year 2. Usually, you need to recognize something from year 1. That's always like this. Year 2, recognize downstream profit for 2001 from year 1. It was 800. Same investment in B, cost of goods sold 800. Another entry, differ ending, downstream profit ending, cost of goods sold, inventory ending 2000. After this, eliminate downstream sales revenues for year 2. debit sales revenues, credit cost of goods sold. We finish this. The last question here, compute minority interest in B net income. You take 6,000 multiplied by 10%. No, you take the same amount, 6,000 multiplied by 10%. That's, you need to know what's this one. Now, after you do this, we still have two examples, example 5 and example 6. In these two examples, we have complete worksheet, we have all these inventories, but at least we have to practice this. You start with 4 examples first. After you understand, for example, go for example 5. After you understand example 5, go to example 6. So 5 and 6 similar. What's 5? That's a downstream sale, but we have worksheet. And example 6, that's upstream. We have worksheet. That means 2 examples. I'm going to show you one by one how to do this, okay? But you need to understand example 1, 2, 3, 4 first. Upstream and downstream. What's the difference? All of this. Let's go this one. This one here, consolidation worksheet. You know what's consolidation worksheet. And the downstream. You know, when I say downstream, what does that mean downstream? Let me read it with you one by one. January 1st, 2001, A company acquired 90% of outstanding common stock of B company at book value. At the date of acquisition, B company stock was 50,000 and the return to earning was 30,000. At the 2001, B net income was 15,000 and dividend was 2,000. During 2002, A company sold, look at here, that's merchandise now. A sold, he's the seller now. Parent, he's the seller, sold, that's why we call it downstream. Sold merchandise inventory to B company. How much is selling price? Both line under 30,000. 30% of this merchandise was unsold and were included in B company. Ending inventory. B company beginning inventory 2002 included the intercompany gross margin was 3,000 and they give you trial balance. Remember this example, they didn't give you the balance sheet. They didn't give you income, they give you only trial balance. You know trial balance, you remember again from accounting 1, accounting 2, they give you debit balance, credit balance. You need to know which one are going to use it here. Read it again. The trial balances of A and B, December 31st, 2002. Remember, this one here started January 1st, 2001. And this one here, trial balance 2002. That means 2 years, okay? Because you have January 1st, 2001 to December, and another one, January 2002 until they have 2 years, okay? Let's see what do you have in the trial balance, please. Debit balance first, A company, B company, cash, debit balance, inventory, investment in B, debit balance, cost of goods sold, and operating expenses. That's all of this for A and B, debit balance is the total. Credit balance, you have AB, account payable, common stock, and A and B, return to earning, sales revenues, and income from B. All of this credit balance, that's this one, debit balance. Okay? Before you answer, you need to read it carefully, see why this one is debit, why this one is credit, what are you going to do with this one. Let's see what it depends on the requirement. Okay, let's go for the requirement here. First one, determine intercompany gross margin on downstream inventory sales, December 31st, 2002. 2002, remember again. Inventory selling price was 30,000 minus cost of goods sold 22,000, give you 8,000 gross profit of gross margin. Remained unsold 30% multiplied by 30, it give you 2,400. That's a deferred profit. Okay. After this, compute income from B in details 2002. What's the income from B? This number, he asks you, where's this number 23,100, where's this number come from? You have to, step by step, B net income, 25,000. Where does this number come from? 70,000 minus 35 minus 10, which is sales revenues minus cost of goods sold minus operating expenses, multiplied by 90%. After this, add defer gross margin beginning, deduct defer gross margin ending, it gives you 32,100. That's he asks you here. Show me where this number come from in details. Okay. Determine the balance of investment in B. The balance of investment 99,300. Again, I'm going to ask you. Show me where this number come from. 99,300. Okay. You need to start from the beginning. Look at date of acquisition. When? Date of acquisition. Look at the example again. Read the example again. Acquisition cost, January 1st, 2001, that's 72,000. Where is 72 come from? Okay. I give you 50,000, that's capital stock, plus 30,000 at the date of acquisition. This one equal to net assets. Remember, this one equal to net asset multiplied by 90%, they give you 72,000. This one, common stock of B, plus return to earnings, that's 50,000 plus return to earnings. This one here, plus income from B, 2001, that's 10,500. Where does this come from? 15,000 multiplied by 90% minus 3,000. This 3,000, that was this one here, net income of B, deferred gross margin. This one here, and the dividends, it gave you 2,090%, I gave you 1,800. This one here, if you take this one, 72 plus 10,500 minus 1,800, it gives you the balance of investment year one, which is December 2001. I ask you, show me the balance 2002. That means you need to continue. Add again income from B, 23,100. Deduct the dividend for 2002, 5,090%, give you this one. At the end, you need to come to this amount, 99,300. That's, you have to do this again many times to understand. Remember this one here, 2 years. Why 2 years? Because date of acquisition was January 1st, 2001, and I ask you for 2002. Okay, let's continue. Consolidation worksheet adjustment. Eliminate income from sub. That first one, income from sub. Debit income from sub B, 2,100. Credit dividend 5,090 for 500, and the credit the difference investment in B, 18,600. Second one, eliminate share of holder, shareholders of B, eliminate shareholder B or stockholder of B, shareholder of B. You go into this one, common stock of B, 45,000. Where does this number come from? 50,000 times 90%, and return to earning 2002, 43, 90%. It give you this one here, and investment in B, it give you, if you look at the other, this one, 83,700. That's 83,700. That's two number, 45,000 and 38,700. That give you 83,700. It's supposed to be credit. By mistake, they put it this way. I'm sorry about this. The last one, recognize downstream deferred gross margin. Beginning, we have 3,000. Investment in B and the cost of goods sold, 3,000. That's okay. Deferred downstream gross margin at the end. Remember, that's the end. Always like this. Debit cost of goods sold, credit inventory, 2,400, 2,400. The last one, eliminate selling price with cost of goods sold for 2002, sales revenues, debit, cost of goods sold, credit. That means this one, sales revenues, 30,000, cost of goods sold, 30,000. That's this one. Okay. Question number 5, ask you prepare the worksheet. Look at the worksheet here. If you look at the worksheet, something here is not right, but we have to look at it one by one. What do you have in this one? Start with the worksheet first. That's example part 4, example 5. Okay. If you look at the, you have income statement. If you look at income statement, how to put income statement. After income statement, you have to return the earning and you have the balance sheet. This one here, it needs more clarification. I will give it to Heba in other copy, because this one maybe is not clear to you, especially with this number. That's this one. I will send the hard copy to Heba with all of this to show you how complete worksheet for example 5. I promise you about this. I will send it to Heba for this one because it's not clear for this one. We finish example 5. Next, example 6, similar. Example 6, consolidation worksheet. This one upstream again. Remember, that's this one upstream inventory. January 1st, 2002, A company purchased 90% outstanding common stock of B at book value. At the date of acquisition, B company common stock was 125,000. Retained earning was 25,000. For 2002, B company reported net income 10,000 and 0 dividends. There is no dividend, 0 dividends. Okay. In this example, that's a difference. In this example, he gave you financial statements. Look at this one. Example 5, he gave you the trial balance. Example 6, he gave you financial statements. Start with income statements for company A, company B, sales revenues, plus income from B, cost of goods sold, operating expenses. It gives you net income, this one for company A and company B. Statement of retained earning. Remember, one by one. Beginning retained earning, and it's also by 35,000. This one here, and plus net income minus 4,000. It give you at the end the amount for this one. And ending retained earning, ending will be for company A and the company B. Start with the balance sheet. You start with cash and AR, inventory and investment and total assets, and AB, common stock and returned earning. Okay, we have this here. Need to know how to classify this one. That is this one. It's a given example to you. This one here is telling you during 2003, again, A company, the parent, purchased 120,000 merchandise inventory from B. Sub selling price sold for B was cost plus 20% of cost. Okay, we need to do some calculation here. At A company, beginning inventory for 2003, returned earning. This one here, 12,000, and purchase B also at A company, ending inventory consisted 36,000 merchandise purchase from B company. If some item is missing, I will give it to Heba. Maybe have the copy to explain any missing number or not required, or some other. Most of this question here required, but some is not clear. I have to give it to Heba if something is not clear to you. Start with the required. Determine intercompany gross margin inventory. Gross margin beginning, this 12,000 selling price, minus 12,000 by 1.2 give you 2,000. Selling price of this one here, that means the gross margin, this one here will be, that's for beginning 2,000, for ending 6,000. You need to know this two number, where this come from, 2,000, where 6,000 come from. That's they give you by equation or. And compute income from B in details. Now, where is this number come from? 27,900. Subnet income, 35,000. Deferred the gross margin on upstream beginning, 2,000. Minus deferred gross margin on upstream ending. Remember, 2,000 and 6,000. This one add, this one deduct. Give you adjusted subnet income. After you make the adjusted, you need to multiply it 90% to give you share of net income 27, the same number, 27,900. And number 3, calculate the balance of investment. MB, December 31st, 2003, in details. Where does this number come from? Start with acquisition cost. It's 135,000. This one here, 125 plus 25. This one here, okay? And 150, 90%. And this one here, income, this one here, it comes to the end. And net income minus gross, this one here, it give you 142, 200. The balance, income from B again, 27,900, year after, second year, 27,900 minus dividend, 9,000. It gave you the end 161 and 100. If something is missing a number, something I will pass it to Heba how the copy to explain this in more details. Okay. After this, consolidation worksheet adjustment. Remember, you have to look at the adjustment again. Eliminate income from B. We have this before. Income from B, 27,900. Credit dividend, 9,000. The difference between 27,900 and 9,000, it give you investment, which is 18,900. Second one, you need to eliminate stockholders' equity of B. This one here, common stock of B, debit, 112,500, return the 29,700, and this one here, investment will be 142,200. And recognize upstream gross margin deferred for year, prior year. That's 2,000, remember? 2,000, we need to recognize it. The same information recognize, after that's deferred. This one recognize, 2,000. Return the earning beginning, 2,000. Cost of goods sold, credit. Defer upstream ending of the current year. That's cost of goods sold, 6,000. Credit inventory, same entries, debit and the credit. Okay. Eliminate upstream sales. Again, upstream sales revenues, and the cost of goods sold. Sales revenue, make it debit, 120,000. Cost of goods sold, make it credit, 120,000. The last one for the worksheet again, example 6 is not clear again. Something with this writing or with this this PowerPoint with this blue items not clear. I will again, but give you some information. Income statement first. After that, return the earning. After that, balance sheet. I will give you how to copy. I will give it to Heba how to copy for example 5 and example 6. I think the whole lecture I will give it to Heba for this one. This one, a conclusion for part 4, intercompany merchandise transfer. Heba can give it to you for 2 weeks, or I think for 2 weeks. After this, she can. But you need to focus on cost method and the equity method first. She will let you know the date of the exam for this, for cost and the equity. And this one here, it come later. We still have part 4 and part 5. Remember, that's about 4. We still have another one, part 5. We can do it within 1 or 2 weeks. We can do this and finish it. That we need to finish at least 5. That's what we have in our plan. Okay. Also, what I'm saying here, you have to be in contact with Heba, Hamza, and Marina, and will help you with more information. And I will give some more information if they need more information. But It was nice. Exam 1 was very good, excellent, with a high grade, very good. Look like you understand part 1 and part 2. That based on part 1 and part 2, continue with part 3. We finish part cost and equity. That's included part 1 and 2. This one, part 4, is later. You can have this exam later. But focus now on cost, method, and equity. After you understand it, you can read this later. Heba will let you know. Okay. Thank you very much for listening to this, and I think for this one that's okay now.